Jack Duval, CEO of Bantam Incorporated, a multifamily office in New York. And I'm coming to you today with the fastest 4 minutes in finance video. So I wanted to first revisit a blog post that I had written back on January 31st, 2019. And this was after the big rally in stocks after the Jerome Powell pivot on December 24th or 5th of last year. So if you recall, at that point, Jerome Powell had announced that the Fed would stop its interest rate hikes and consider slowing the balance sheet reductions. And there was this meme out there about the stock market vigilante. And I said that that was a trope of an exhausted stock market full of hope and yearning and signifying nothing. That's still the case. You'll see that I talked about how a long series of rate hikes plus a pause equals pretty much a recession and significant market decline. And I had pointed out that in this chart, the white line here is the Fed funds rate and the green line is the S&P 500. So you see there's a period here where you have a long series of hikes and then a plateau, and the market declined by 48%, and that was the tech wreck. And then you'll see there's a long series of hikes here, plateau, and then the market declined by 57%, and that was the global financial crisis. And now we've had a long series of hikes, and now we're on pause, and I think we're going to get a market decline. And I showed how this is the 2-year treasury yield, and you'll see this long series of rising rates, rising yields on the 2-year treasury. The relative strength was historically extremely overbought, and it just come through the 70th percent overbought reading. That's usually a great sell signal. And so my prescription was for clients to begin selling stocks and buying the 2-year treasury. So let's take a look at how that's fared since then. So I've got a chart here, which I'm going to blow up. And this is the white line is the 2-year treasury yield. And this starts on January 31st, 2019. That's the day I wrote the blog post. The white line is the treasury yield, and the green line is the S&P 500 level. And this shows the percentage change since then. So you'll see that the yield on the 2-year treasury has declined by about 24% since I wrote that blog post, which is fairly incredible in roughly 5 months or so. And the S&P 500 has gone up, call it 6.8% here. Now, the 2-year treasury would have gone up maybe not 6.8%, but somewhere close to that, a reasonably good single-digit number. So you'd be roughly flat, maybe slightly down, but with taking essentially no risk compared to being in all stocks. So that's been a pretty good trade so far. I don't know if the 2-year treasury is going to have another decline, like 24% over the next 5 months, say. Probably not. It could continue to go down. It should. But the stock market's what I think is really going to come down now. And one of the things I've talked about over time is the volatility of the fixed income market, which is called the MOVE index, and I've written about this. And I want to just take a look at this. So this is the white line is the volatility of the U.S. Treasury market all across the curve. So from short term to all the way out to 30 years. And I had spoken about and written about how the MOVE index really needed to start to ramp before we would see um, a lot of downward movement in the S&P 500. So we're starting to see that. It's ramped up to over 80 now, and you'll see we can just bring this in a little bit. So you see it's been very low down here between 50 and 60 over the past few years, and now it's ramped up. And historically, when this has happened, it has presaged recessions, and that's what these red bars are here. These are recessions. So you'll see, usually get a ramp in the fixed income volatility. You certainly did back here, although not so pronounced back in the early 90s, somewhat. You got a pretty good ramp here during the financial crisis, and then you got a big ramp here during the global financial crisis. So I think we're heading back towards those levels. Who knows exactly how much? Could it get up here to 200 like in the global financial crisis? It could. I think certainly we're heading over 100. But that's been a pretty good indicator over the years. A few other things that I've talked about, just I want to touch on quickly. In Europe, it's a complete disaster with Deutsche Bank. I talked about Deutsche Bank before. What's happened is the negative interest rates in Europe have essentially bankrupted the banks. What happens with negative interest rates is you destroy the spread business of the banks, which means they borrow short-term and lend long-term. That's a spread business. So if your interest rates go negative, you essentially are defunding the banks because they have to now pay interest on the short term, and it just kills their profit margins. And you'll see, I mean, Deutsche Bank is up here before the financial crisis at 88, and now it's trading at a hat size, 615, probably going to a glove size. At some point, the German government will privatize it. It will not go bankrupt, but there's going to be big haircuts for equity holders, and who knows, possibly bail-ins by bondholders, meaning that the bondholders get haircut. We shall see. The fourth thing that I wanted to talk about, and the last thing, is the 30-year Treasury rate. And what you'll see is I've got a chart here that shows the 30-year rate, which of course, the Federal Reserve did not control long-term rates. And let's see, I'll make this a little bit bigger. So what the Federal Reserve controls is the short-term rates, or at least it thinks it controls those. It does to some degree. But the long-term rates have been heading down in kind of a step function. And you'll see that we go back to the 80s. Paul Volcker, who was the last independent Fed chair that we had, broke the back of inflation here, starting in the early 80s with the Saturday Night Massacre, and really brought inflation down. The 30-year rate, unbelievably, was at about 15%. Imagine that. And brought that down to 8%, and we plateaued there at 8% for about the mid-80s to the mid-90s. And then we take another leg down here from 8% to 6%. And this is kind of after the recession in the 90s. And then we kind of plateau here in the 6% range. And then after the tech wreck, we take another leg down to around the 5% range. And then we plateau at the 5% range. And then after the global financial crisis, we take another leg down in 2011 to about the 3% range. And we've been there, and now it would appear that we're taking another leg down to possibly the 2% range. So what's going on here? This is I think, a secular, well, it's definitely a secular trend. It's a long-term trend in interest rates and it reflects the lowered growth potential of the U.S. economy. And we are essentially going through Japanification, where we're running up huge debts. We have huge deficits. They appear to just be getting larger. And it's not like we're going to default on our treasuries or anything like that. But we're just running up more debts, and that just limits your future growth potential. So I've been bullish on bonds long term. I think that's going to continue. I think we're going to take another leg down and probably get to at least a 2% plateau. You know, Japan is essentially at a 1% or lower rate on their 30-year bonds. We'll probably be heading for there too. You know, not most, but around, you know, a good 30% plus of global government bonds have negative yields. So it's very, very difficult for the U.S. to have much higher rates over time because the rest of the world is exporting deflation to us. And that means that this kind of step function down of interest rates should continue. So, Jack Duval, CEO of Bantam Incorporated, thank you for listening.